Hey there, and welcome back to The Explainer. Today, we're tackling Section 5 of our U.S. Tax System for Accountants series, Individual Taxation, Filing Status, Calculation, and Rates. Now, in our last session, we cracked open the whole world of business entities, but today, we're shifting gears to the personal side. We're going to walk through a rigorous, step-by-step breakdown of how individual taxes actually work under the hood. And as you'll see pretty quickly, understanding the strict sequential waterfall is just absolutely crucial.
So here's our roadmap for today's Explainer. First, we'll look at determining filing status. Then we'll walk through the tax calculation formula. After that, marginal tax rates explained, and we'll wrap up with capital gains and dividends.
Okay, let's dive right into this. Section 1, determining filing status, the gatekeeper of the return. Listen, before a single dollar of tax is ever calculated, you've got to figure out the filing status. It is the absolute baseline. This one choice dictates both your tax brackets and your starting standard deduction. If you get this wrong, it literally corrupts the entire calculation. So you've got 5 distinct statuses. Single gets a standard deduction of $14,600 for 2024. Married filing jointly exactly doubles that, bringing you to $29,200. Married filing separately drops it right back down to $14,600. Then, head of household sits in the middle at $21,900 for unmarried folks with dependents. But hey, look closely at that bottom row. This is super important. A qualifying surviving spouse, which is a widow or widower with a dependent child, they actually get to match that married filing jointly standard deduction of $29,200 for 2 full years after their spouse passes away. Like I said, this choice determines your starting deductions, so getting it exactly right sets the tone for the whole shebang.
Moving right along to Section 2, the tax calculation formula, or as I like to call it, the calculation cascade.
So, for individual taxpayers, getting from your gross income to the final tax owed, it's a highly rigid sequence. Every step depends on the last. And before we map out that full journey, we absolutely have to highlight the real MVP of the tax return, adjusted gross income, or AGI. AGI is that critical subtotal you hit right after subtracting your above-the-line deductions from your gross income. Now, why is AGI such a big deal? Well, because it acts as the financial threshold for almost all the phase-outs and limitations later on in the return. Seriously, if you miss an above-the-line deduction here, something like student loan interest, self-employed health insurance, or a retirement contribution, your AGI stays artificially high. And the massive consequence of that? You might inadvertently phase your client right out of some seriously valuable tax credits or itemized deductions further down the cascade. It is a big deal.
And this perfectly illustrates that full journey. Let's walk through it. Step 1 is gross income. That's everything from your wages to dividends to rental income. From there, you subtract your above-the-line deductions, and boom, you reach Step 2, AGI. Okay, so from AGI, you're going to subtract the greater of your standard deduction or your itemized deductions, plus any Section 199A QBI deduction if you've got pass-through business income. That math gets us down to Step 3, taxable income. This is the actual literal base that your tax rates are applied to, which brings us to Step 4, gross tax liability. But hold on, we're not done yet. Next, we subtract any tax credits, like the child tax credit or education credits, to hit Step 5, net tax owed. And finally, you deduct what's already been paid throughout the year via payroll withholding or estimated quarterlies to arrive at Step 6. This is your final settlement, meaning either you get a refund or you owe a balance. It is a strict, unyielding waterfall from Step 1 through 6.
All right, Section 3, marginal tax rates explained. And what's really interesting here is how this sets us up to bust the notorious bracket creep myth.
People constantly misunderstand how tax brackets actually function in the U.S. system. It happens all the time. So let's bust this myth right now and anchor all this abstract math with a real-world scenario. Imagine a married couple filing jointly with exactly $400,000 in taxable income. I can't tell you how many times I've heard even smart professionals look at a bracket table and say, oh, they make $400,000, so they're in the 32% bracket. They're going to lose nearly a third of all their money to federal taxes. Well, that is mathematically false. No way does it work like that, and we need to understand exactly why.
Okay, take a look at the full 2024 table for married filing jointly. You can see the 7 rates scaling from 10% all the way up to 37%. The U.S. uses marginal progressive brackets. So, the absolutely crucial point here is that our couple with $400,000 in income does not pay 32% on their entire income. Not at all. Instead, think of it like a layering mechanic. They pay just 10% on their first $23,200. Then, once that bucket is completely full, the next chunk of money spills over into the next bucket, and they pay 12% on the income up to $94,300. Then 22% on the next layer, then 24%. It's only their final slice of income. the specific dollars sitting between $383,901 and their total of $400,000 that is actually taxed at that highest 32% rate. Which naturally brings us to this critical distinction, the marginal rate versus the effective rate. Your marginal rate is simply the highest bracket that your final dollar of income triggered. So, in our couple's case, that's 32%. But their effective rate, that's the actual blended average they paid across all those lower buckets combined. It's going to be much, much lower than 32%. Honestly, confusing the two leads to terrible tax planning, unnecessary fear, and totally misinformed clients. Solidifying this difference is an absolute must for intermediate professionals. You've got to know this cold.
All right, let's move into Section 4, capital gains and dividends, ordinary versus preferential rates.
Up until now, we've just been talking about the standard bracket rules for things like wages and business income. But investment income introduces a whole different ballgame. It's really a dual-track system. Over on the left side of the screen, we have short-term capital gains, so assets held for 12 months or less, along with unqualified dividends. These are taxed as ordinary income. That means they just get dumped right into those standard 10 to 37% progressive brackets we just looked at. But now look at the right side. Long-term capital gains, meaning assets held for more than 12 months, and qualified dividends. These get preferential tax rates. Depending on your overall income, they are taxed at incredibly low rates of 0, 15, or a maximum of 20%. Think about that for a second. Holding an asset for 365 days versus 366 days can drastically change your entire tax bill. It's huge. Misclassifying these assets on a return can easily lead to a client severely overpaying or underpaying the IRS.
But wait, there is a hidden trap here for high earners that we absolutely have to talk about, 23.8%. Now you might be wondering, where does this number come from if the top preferential rate is 20%? Well, there's an additional tax called the net investment income tax, or NIIT. It taxes on a 3.8% surtax on investment income for single filers earning over $200,000 or married couples earning over $250,000. So in reality, this means the effective top federal rate on long-term capital gains actually hits 23.8%, and that's before state taxes even enter the chat.
And that brings us to the core reality of individual taxation. If a single error all the way at the top of the waterfall, like picking an incorrect filing status or missing just one above-the-line deduction, corrupts the final settlement all the way at the bottom, how foolproof is your sequence? Because in personal tax, sequence is literally everything. Keep that provocative thought in mind as you review your own tax strategies. Next time, we're going to tackle exactly what happens after the math is done in our explainer covering tax payments, deadlines, and IRS enforcement. Until then, keep learning and keep it structured.